Hello everyone, it's me, the Boss Dog. We're back for another portfolio update as of the week ending the 16th of June. We're going to be having a deep dive into KNOS today, which I think a lot of American and non-British viewers won't know at all, but in my opinion it's a profitable workday play and I'm going to explain why. We're also going to be having a look at the really positive trading update from Games Workshop, as well as, again, another positive sort of investor deck that was produced by Medical Properties that really helped sort of put a floor on their share price as well. Let's do it. Alright, so straight into portfolio, and in terms of changes since last report. Now, unfortunately I couldn't do a report last week because Google database decided to just have an absolute freak out, but we're back, and actually though, not much has happened to be honest. June is a fairly big month for me, dividend wise, but so far I've only received a couple. A lot of the rest are right in the final few days, although I am having a big one from Gamma next week. In terms of what I've received so far, I did get a very small one from Fever Tree. Now I've since sold Fever Tree because I thought, following some rumours that the share price shot up and it basically was at least a year ahead of itself, so I decided to take some small profit and sell, but I still got a dividend. Put it into my global REIT here, TRET. It's a bit beaten up at the moment, as most REITs are, for I think pretty obvious reasons, with the base rates in most countries being what they are. But anyway, I'm about down 5% on that and continue to just buy into it gradually, standard stuff. And then I also got a very big one from Legal and General. So as a member of Briscoe, or Paul Briscoe's Discord, I'm on the Legal and General hype train. I think it's one of the most defensive and solid investments you can take out in terms of getting hold of a FTSE 100 mainstay. And so I just put it straight back in here at 239. I'm in at the moment for a smidge under 250, I think. So I'm down a couple of percent here, but again, very happy. UK insurers at the moment are really beaten up, but I think the long-term quality will come good. So that's all I've been doing. I've not been depositing a ton. I do have a fair few thousand in my bank account at the moment, but I have what's called an offset mortgage. So I'm just putting it in there as a very safe return on my money. A lot of the investments now look quite expensive, if I'm honest, especially some of the tech. And so I'm just not really feeling it. And also potentially, although I can't really talk about it, I'm officially, NDA'd. I do maybe have an investment opportunity over the next few months, so I'm starting to look to build up a cash reserve anyway, just so I can potentially take advantage of something. When that materializes, or if that materializes, I'll be sure to bring it though and be nice and transparent as normal. But for now, I just can't talk about it basically. Anyway, in terms of dashboard, so we're going to start down here. Now, last week I wasn't even able to save what my status was, so I just decided to leave a week there. But you can see more or less pretty unchanged in terms of percentage. My P&L is up sort of 400 there. My trading 212 is up 700. Again, there is normally a small delta between the two, so a small improvement. But more or less, I've been trading flat for a couple of weeks, although that sort of glosses over some fairly big day movements. So it's been a pretty interesting couple of weeks for sure. If we return to the top now, again, there's definitely a big difference. This normally happens on Friday. I swear during the week we're almost bang on. But the trading 212 here is arguably the one that matters more because it's physically what's in my brokerage at the moment. And yeah, and so far we're only up to 6,400 out of 40,000, but so I'm technically a couple of weeks behind where I would normally be. But again, that's to be expected, and I'm fine managing stuff how I am at the moment. I think here this graph, which it still remains my most important graph. Normally when I'm sort of behind the indexes, I feel a bit like sad, but actually I feel really good about the level at the moment. Like, I'm starting to pull away from the FTSE 350, and although I've now fallen behind the S&P, honestly a lot of this is currency, basically all of it. Like, if it wasn't for unfavorable currency movements this year, I'd be ahead. And considering like how the Nasdaq specifically has performed and how tech more generally has performed, I'm sort of really happy with just being slightly behind the S&P. At one stage during this last couple of weeks, I was actually ahead following one of my companies sort of running up a little bit, but since then got pulled back, and again the FX at the moment just is very unhelpful. But my portfolio still remains at very near all-time highs, as you can see, and broadly speaking, I'm feeling really positive at the moment. It's funny like how your mood can just change, and yeah, feeling absolutely fine. My UK position is now back to being in the black. My UK positions, because I have a couple of Russian miners but London listed, has taken a beating for 15 months, to be expected. So this is only the second time in 15 months my UK profit specifically has been in the black. And as we'll get to in just a second, that's being really supported by one company who had a really strong last week. Not quite at all-time high profits yet. This is the third highest profit I've ever had, and generally it feels like a very bullish market. But again, I'm not personally convinced, and even though I'm trying not to outright time the market, You know, considering I think it's overpriced anyway, I just think there are sort of safer ways I can get 5-6% at the moment in a bank, and basically wait for better times to buy, or potentially take advantage again of this investment opportunity in the future. So feeling pretty good from that perspective. Also, as well, just as a quick view, if I look here at year-on-year change, like a lot of this makes me feel really positive. Like, even accepting that in the past I might have overpaid for stuff or made some mistakes, like I still believe I have a really good core portfolio. Very happy with the spread here. A bunch of these are sort of outperforming even, you know, very aggressive comparisons in technology. And yeah, although there definitely is some red here, you know, a lot more of this is green than red, especially my sort of higher positions here, which are, you know, until I go down to, is this Phoenix? Yeah, until I go down to Phoenix here, so my main UK insurer, again, pretty beaten up. But yeah, I feel pretty good, honestly, just looking at this, like there's a lot of green. In terms of how things are doing, again, I continue to maintain the Gamma's an absolute buy at these levels. Amcor feels likewise as well, although again, it's sort of recovered from the dip it did have even further down than this. Genius is pretty interesting. So again, as anyone who's new won't know this, but for anyone who's been following me for a while, I went on a market day call for Genius almost 18 months ago now, and was basically ready to walk away, you know, with like a 70% haircut, like, and just sort of put it down to lesson learned. But I really liked what I heard and saw, and sort of had a new understanding for the business, which is an ex-SPAC. And, you know, this is basically my one remaining hangover from the SPAC days of 2021, but I still really like it. Anyway, it had an earnings target of $8 put on it by one of the big banks, which I have to say, I think that's an aggressive target. If we got to $8, I'd basically be in the green again, so that'd be fantastic for me. Like, for me, I think this company should be like in the low to mid sixes, and actually following the update, that's where it got to. At one stage, it was at like 6.30, but since then, it sort of had a pullback a little bit as people sort of look forward to it becoming profitable, but it isn't quite yet, although again, for me, it's got a very clear and is delivering on that sort of trajectory. So I remain really invested in Genius. I technically have this split over two portfolios. It's my only holding that exists in more than one portfolio. So my one in my non-ISA, so general investment account, did actually turn green, and that was a nice surprise, but most of it is still pretty red, so down about 25% on this, so but definitely been a lot worse than it has been in the past. I think it's worth highlighting Games Workshop, which pretty much has carried my portfolio for the last couple of weeks. I really like Games Workshop. They actually put out like a 4-line trading update. When they publish their results in a month's time, I'll review them properly. But basically, within the 4 lines, 2 lines of them related to the bonuses that they've paid. All right, fair enough. And then 2 lines actually related to a trading update. And it was specifically not less than £440 million in revenue and 157 million in profit. Now, to put that into context, that's a net profit margin of over 36%, so beating out, you know, Microsoft just about, and Apple actually quite comfortably. And I think a lot of people don't realise just what an absolute financial beast Games Workshop is. Like, it's a smallish company, you know, it's sort of $1.5 billion market cap, but it's got like the strongest of moats. I mean, it's its own product effectively. So as long as there's a market for people willing to pay, you know, lots of money for primarily miniatures and paint, then Games Workshop's just going to continue to throw off money, basically. And they're now really cash generative and have like a 5% yield despite being a pretty small company. And, you know, had a really strong week, so up 15% on this trading update, which to me was sort of in line with what I would have expected. So again, to me, it's just a case of the market not really believing it. And when I was reading also, a lot of the commentary was pinning this on Amazon, and I don't think that's correct at all. Like, I think actually what's really happened here is that a lot of the headwinds that Games Workshop's been encountering for the last couple of years, right? So that's higher petrol costs, right? A lot of it's it makes plastics and paints. Then it's got freight costs, logistics costs, right? As it picked a bad time to do international expansion. But, you know, it basically added to its molding machines, to its paint facilities, to its distribution network, and run into sort of very high cost headwinds as it was doing so. And now, you know, like maybe there's a modest amount of improvement in revenue as a result of, you know, the Amazon deal and just making it more knowledgeable to people who might not have been so familiar with it before. But I don't really think that's the main catalyst here. The main catalyst is that Games Workshop has spent the last few years basically investing. And even, you know, like even if we take it so far as their CRM and product website, you know, it's actually been much improved and was previously delayed. But this time, like, they've recently just launched what they call a 10th edition. So this is sort of a once every 3 to 4 year event, you know, big changes in the lore and exciting stuff. And actually, I'm hearing that it was pretty well received, and that actually ordering online wasn't a particular headache like it's been in the past. And again, it just seems like a lot of the investments that Game Workshop has been doing is starting to bear fruit. And again, like as soon as licensing kicks in, which is more or less flat year on year, as soon as licensing kicks in from anything to do with Amazon, it's just going to be absolutely humongous. So I think, again, people are infatuated almost with the Amazon stuff. And to me, like, it's almost a shame after this 15% run up, because I don't think there is sort of a huge delta now between fair price and what this company is actually on. I think it's sort of like, you could maybe add another 10% to this, but outside of that, there's probably better buys in the market, to be honest. But if I was looking for an entry into Games Workshop, I would be praying that the Amazon deal actually fell through, because it would cause a mini collapse in the share price. At least 20% down would be my expectation. And actually, for me, then that would be the buying opportunity, because this company will be profitable with or without Amazon. And yeah, the market is overlooking really, really strong financial metrics and fundamentals within this business. So just as a little bit of an aside there. I'll also follow that up with medical property. So actually one of my worst performing shares, but again, I've spent so much time looking into medical properties. It's a real Marmite stock. Like, people either love it and think, like people are crazy for not seeing value in it, or it's kind of a case of, it's ranging from sort of fraudulent or a basket case, or, just burning your money basically because of various scenarios. And I just think like this to me is, okay, sure, maybe it's one for the riskier investor, but actually in a way I think it's one for the more rational investor. Like, unless you truly believe that the company is about to hit the wall, and or that there is some sort of fraud going on, I think this is a screaming buy basically. If you have a modest risk tolerance, to the point you're willing to buy individual shares, it's so cheap. Like, even if 30% of their revenues were to get, not produced this year because, they have problems with a couple of their larger customers, they would be fine. Like, sure, and at the moment, the dividend's so high, this is like a 15% yield. So even if the dividend did need to get trimmed, it's just like, I just don't see it becoming a problem to the point where it's going to be stopped altogether. And, it has had a bit of a recovery, sort of, it's up sort of about 15% from its lows. But to me, this still looks really cheap. And again, you sort of have to be a bit maybe more of a long-term investor here. But I forever feel like the bearish arguments against this company are overdone. There's always a bearish argument of the day. If it's not sort of Stewart, it's somebody else. And if it's not sort of, financials linked to previous, it's financials about, how they're going to get new borrowing and investment at high interest rates. It's just like, it's one thing after another, and I don't think that's like, basically people are just looking for problems. And I think actually if you're calm here, and read this investor deck, which is really what put a floor underneath the share price, because like, basically it required MPW themselves to sort of do the business case, which, again, maybe MPW at the moment are sort of a big target for short sellers, to the point that MPW have actually launched a lawsuit against one in particular. So yeah, maybe it's sort of what you'd expect from the company. But again, I really think that the market shouldn't be waiting for the company to make its own point. The market's meant to be like this efficient thing. And even though accounting for the fact the market clearly isn't, and it's emotional and all the rest of it in the short term, I think we as investors need to like not wait for MPW to put out this deck. Like, the numbers are all there. It's just MPW brought it together, done some comparisons against some of their competitors, and basically done the hard work for you. So this investor deck was well received. It remains on their website. It's only sort of a 15-page deck, so well worth a read in my opinion. It'll take you less than an hour to read through it, and at the very least, you'll get more informed as a result of it. The other thing here I want to talk about is Kainos. Now I'm going to delve into their earnings in just a second. Oh, I put the notes here against the wrong company. Let me just move that down. You can tell here I was doing some organising. There we go. So next one here is Kainos. Now, this is a company we're going to delve into in just a moment, but I will just say that they had, literally as soon as I did my notes and produced the video you're about to see, they announced this DVLA contract for 35 million. That was also on top of the Driving Standards Agency and MOT contracts that they received like a month ago, so that was another 10 million. So together these are sort of like just over 45 million. And this is part of Kainos' journey, I suppose, but again, we'll touch on that in just a second, because Kainos has had also a pretty good week following this, but I still think there's money to be made in Kainos, actually. Like, there's more of a gap between the current price and what I believe is fair price than, for example, Games Workshop. So yeah, we're going to have a deep dive into Kainos in just a second. Outside of that, just scanning through this nice and quickly, you know, a lot of things have been trading flat. My mining ETF did actually turn green just momentarily, although it's back to very slightly red at the moment. So, and that's just on the back of sort of some bullishness coming out from Asia. But then there was also some bearishness coming out of Asia. So fine. For me, you know, like getting into mining is sort of a long-term commodity hedge, I suppose. So we will continue to invest in this. Obviously, my mining exposure in the past hasn't worked out too well, being Russian miners, but there we go. I will also just talk about Redrow, which is my house builder of choice. So again, this is another stock at the moment that's been all over the place. I remain really bullish on the valuations of UK house builders. I like Redrow in particular because it's not exposed to the sort of more currently risky end of the market, so things like first-time buyers, etc. Redrow basically builds forever homes in suburbs where, you know, the land rates are cheaper and where the turnaround is faster, so I think they're less exposed anyway. But basically all of their UK house builders got absolutely battered because UK inflation continues to be a bit of a joke at the moment, and our Bank of England continues to basically sleep on the issue and blame everyone else except for themselves on it. So the expectation from the market is effectively the Bank of England will be forced to respond much more aggressively than people realise, including apparently the Bank of England. And this kind of does a couple of things for my portfolio. So specifically with Redrow, because this makes borrowing more expensive, it should make housing less attractive and therefore put a ceiling onto Redrow. Also, that has the impact of FX, which is really why my foreign exchange is getting hammered as much as it is. And just to put this into context, for each cent that the dollar weakens against the pound, basically cost me about £600 profit in my portfolio. So it's quite significant. Like, and it doesn't take much. You know, at the beginning of the year, I was expecting sort of a 120, so now it's currently, you know, in the high 120s. Yeah, it's definitely being felt, put it that way. So again, I'm trying not to look at that too much. I can't do anything about FX at all, and basically just ride with the punches essentially, and kind of again try to look past it. So, which I think I'm actually getting better at doing. But yeah, so that's that. I think that's everything for now. Nothing else too much here. Again, it's been a weird couple of weeks where more or less most things have finished flat. Just these call outs here. And so without further ado, let's move on to our review of Kainos. Okay, so no camera this week, honestly, because it's absolutely baking in my flat, and I didn't think a sweaty boss hog would do Kainos any favors, but we can still walk through them anyway. So Kainos basically are a major reseller for Workday services, which is basically the product that Workday Group do. So that's $WDAY. And Kainos are a UK listed and domiciled in Northern Ireland IT company that can be thought of as three divisions within their company. Not thought of, by the way, that's how Kainos position themselves as well. And it makes tons of sense. So in terms of digital services, which is still the majority of their business, this is basically non-recurring digitization software projects. So this is really what the DVLA stuff relates to. It's awesome in a way because it's sort of, again, their bread and butter, but it tends to sort of limit the forward guidance in terms of recurring revenue. So it's kind of in a way a bad thing because obviously the market loves certainty, it loves being able to project that forward. But this division has been growing really strongly for many years and really has given them a kind of base to focus on the Workday stuff as well. So it's still pretty good, as you can kind of see, but it's starting to slow down a little bit as they kind of grow. But again, you can still see here there's lots of scope, and this revenue figure is before their DVLA contract for 35 million. So you can kind of see why that's such a big contract, right? Like it's basically you know, about 15% of their yearly revenue just on that one contract. So very significant. KNOS themselves quite regularly talk about the opportunities for closer work with government agencies. They're currently doing a lot of work in Canada as well, and they've recently got sort of tier 1 approval to target US companies for Workday specifically as well. So this is kind of like a dual purpose between sort of targeting North America's with both you know, non-recurring software development as well as recurring Workday services and products. Now, in terms of Workday services, huge growth year on year. This is sort of non-recurring, as it's basically project management costs, but I would describe this as sort of a funnel into Workday products, which we'll get into in just a second. And this has really been growing very rapidly for quite a few years, 5-year CAGR, 47%. And yeah, this is basically, you know, where the company will work with Workday to do the project management, the installation, the setup of Workday itself. So this is, again, non-recurring to be clear, but again, very strong growth. And then similarly here, Workday products. And so this is where I think KNOS really separates itself from some of the other resellers within Workday's network. And this is Workday products. So this is where KNOS themselves are basically developing tools that implement with Workday. So these are their own tools, not Workday's, but they sit alongside Workday's. And here they talk about sort of smart testing, audit, shield. It's pretty much what you'd imagine. So these are sort of like finance overlays to basically stop fraud, to enable sort of quicker development testing, and to basically have audit functions within the Workday system. So pretty interesting here as well. And again, not quite as good as Workday services, but still pretty good. And effectively here, you know, the idea with KNOS is to develop that relationship with the customer using Workday, and then to sort of develop a longer term relationship, almost like as a supplementary products to the core Workday solution itself. Now, in fairness, the Workday division definitely becoming more prominent, and I think one of the few negatives about their trading update was effectively that their margins were squeezed a little bit, but it's really just because they're focusing so much on R&D, which is basically developing new IT for Workday products. And as they've started to launch into North America, their marketing has increased, I mean, more than doubled. You can see that they're a huge increase to over, well, more or less 11 million. So what that basically meant is, although their revenue is up, you know, stellar, and their profits are still up, but they're up less than their revenue, as they've sort of looked to sort of hire more people as well, more R&D, more marketing. And again, to be honest with you, I don't really view this as a bad thing. Like, this is a growth company that's still relatively small, not quite a penny cap any longer, but you know, in just over 1 and a bit billion. And yeah, lots of potential, but it needs to sort of scale up to get that. So it's the largest European partner. Again, there are lots of ways you can measure this, because you know, you can say that Accenture is based in Europe and is clearly selling Workday solutions in Europe. But the way that KNOS themselves phrase it is basically, you know, they are 100% in Europe until very recently. And you know, basically you can use this metric. So it's a bit generous, it's a bit of a marketing term, to be fair. The important thing here is really the fact that, yeah, they became this US phase 1 partner, as they call it. So there should be some real opportunities here, and that's the hope of me as an investor and KNOS themselves. So they are targeting a profit of 100 million over 3 years. Honestly, that feels very reasonable to me at current growth rates. Like, if they were to keep up their current growth rates, they would exceed it, you know, with almost a year spare. They're running about 9 months ahead of schedule at the moment, but again, I'm not necessarily expecting the sort of growth that we are seeing at the moment for the next 3 years, but maybe. But I think this is actually fairly comfortable in terms of the target. So effectively here, the way you can look at this is you're sort of having a 3-year forward PE of maybe about 15. But again, this is a relatively expensive investment at the moment, and it does require you to be quite bullish, I would say, in order to invest today. But this is sort of your forward guidance for this growth company. Yeah, so this is sort of what I've already touched on. They have set expectations that R&D is expected to remain elevated and potentially grow for the next couple of years. Employees up 11%, which again is quite consistent, and again they expect that to continue to grow overall. I would say that their retention and engagement metrics, both in terms of minimizing staff attrition and actually selling into their existing base, is kind of incredible, to the point that their cash conversion is actually way over 100%. Because what happens is, you know, like any customers that don't pay or the relationship doesn't work out for any reason is more than offset by companies' relationships that do work out, and basically they end up selling more stuff than they originally contracted to sell. So they're sort of, yeah, the cash generation and all of that is really impressive and very positive from that perspective. So yeah, so currently existing customers account for 88% of revenue, and that isn't because they're not dealing with new customers. Again, DVLA is a new customer, despite, you know, being alongside the standards agency and the MOT. But it's just the fact they're so good at keeping their existing customers, basically. So I think it's really impressive. Net revenue retention even more impressive. And yeah, the cash conversion, sorry, 104% for cash conversion. That's for all customers. So effectively, the way I see this is, once KNOS get in, they're incredibly good at keeping their customers, and they're even better at sort of upselling and cross-selling additional services, which again is exactly what I want to see from an IT company that historically has been getting a lot of its revenue from a non-recurring basis. So if you're sort of a more safer investor, your focus here is going to be on the Workday products, and that's going to help you plan years into the future with comfort Right now, I would say that investing in Kainos, not just from a size perspective, but because of the nature of its revenue, is on the riskier side. But again, I think it's a real high quality company, so take for that what you will. If you're into this stuff, they are already carbon neutral and they plan to be net zero by 2025. This is something actually that's really started to be of interest to me. Like when I look into sort of small companies, so let's say under a £3 billion market cap or $5 billion market cap, that kind of area. So not penny stocks, but also, you know, not established behemoths. Something I like to see is basically that they're really starting to think for the future. And I think really the reason why is that they're obviously in such a comfortable financial position that they have the luxury to think that far ahead. I kind of credit this to reading Peter Thiel. He has sort of an interesting view when it comes to the benefits of monopolies. So he wrote this book called 0 to 1 that sort of changed my perspective on how I think about monopolies. And that was something he was talking about with the likes of Google. You know, Google can have these lofty aspirations about doing no evil and solving energy problems or whatever else they want to solve, because they're such an obscenely profitable company that they can, you know, not worry about the company's survival because it takes care of itself and think about the future. And, you know, when I was reviewing Hollywood Bowl a couple of weeks ago, it was a very similar situation, right? The company's hedged itself years in advance, which has been really beneficial. Currently, they're putting solar panels on all their estate. You know, they're sort of able to think years ahead because of how profitable they are. And that's kind of something I'm starting to see a real pattern of. It's something that, yeah, it's starting to become a real thing for me as an investor to see. Like if I see small to medium businesses that have the potential to become big businesses, like Kainos in particular, then something I want to see is that forward mindset. And that's what I'm seeing here, basically. And so alongside this, they basically built a college campus on one of the universities in Northern Ireland. They also have an entire engagement division that basically works with schools to improve, you know, IT awareness and sort of make it more attractive as a future industry for kids. And again, I just think that's a lovely thing. Like I'm much more in favor of these sort of company policies that will have genuine impacts on individuals rather than these lofty ESG goals or something else. Like to me, this is much more what I want to be seeing. And it kind of puts Kainos on the in the consciousness maybe of people that deal with it, and it's one of the largest employers now in Northern Ireland. Like it's kind of, I know that's a relatively small market, of course, but at the same time, like it's becoming more and more known, and I think that can only be a good thing in the sort of medium term. Also, so one of the reasons why I prefer it to Workday, and you know, like the thumbnail here and the front introduction was, you know, it basically Workday is still struggling to become profitable, whereas Kainos is becoming increasingly profitable. But it's actually outpacing Workday themselves. So, you know, Workday plan to grow 17% year on year over the next 3 years, and you know, like Kainos here are more like 40%. So it's not just outpacing them by a little bit; it's basically more than doubling their growth. And I just like I actually owned Workday for a little while when I first got into investing because I really like it as a piece of software. I think it's still to this day the best HR system I've ever used, and it's a solid financial system as well, though I do think there are better ones, to be frank, like probably Sage would be a good choice there. Microsoft Dynamics is fine as well. But I think it's like a very well-rounded system, and you know, a lot of companies, they sort of have a very integrated finance and HR function because things like payroll tend to be highly sensitive. So it makes a lot of sense from that perspective as well to sort of look to have a relationship between those two parts. But yeah, this is one of the reasons why I prefer it. Like not only is Kainos profitable, but it's just growing a lot more easily and quickly than Workday is. So yeah, I just prefer it as a play. Like if you like Workday as a product but are less won over as Workday as a company, which is me, then Kainos is a great company to get you exposure. Like there are other listed companies that you could get into that will have a little bit of Workday exposure, like Accenture, for example. But I just think like Kainos has such strong exposure to Workday, and its kind of long-term recurring revenue is all based on Workday as an add-on. There's also the possibility here eventually that Workday might buy Kainos, although I don't think it's I don't think it's very likely at all, to be honest. But you know, they may well sort of take an interest in the IP that they're basically introducing into Workday as a product, right? Because these are presumably recurring revenues that Workday themselves would quite like to have, but they don't. So an interesting approach. They also have over 100 million cash on balance sheet. So again, you can kind of see what this looks like in terms of their revenue, right? They're currently doing sort of nearing 400 million, and they have 100 million of cash on the balance sheet, as well as 9 months worth of backlog orders. So, you know, together you take that as a year's worth of orders. So this is something as well, like when I read some of the more bearish arguments about KNOS, and to be clear, there aren't super bearish arguments. Like a lot of people like KNOS as a company, they just question the valuation and or the nature of the revenues, which is fine, like I get it. But this is, they still have a year's horizon, which isn't too bad. And so I think it sort of diminishes the bearish argument a little bit on that front. But again, a lot of people think KNOS is a good company. It's just a couple of sort of issues that they have with it. So it does still trade on a forward PE, a current forward PE, so the next year of 27, which is expensive for sure, but it's below its 5-year average of 35. And I think especially before the DVLA announcement, it was more of a bargain, to be honest. It's now sort of its forward PE is more like 30 at the moment, but it's still, I would say, an interesting entry if you do take a more bullish position on KNOS. So definitely not cheap. You definitely have to have confidence, and I would say this is at least a 3-year hold. Probably more like a 5-year. You want to be holding this closer to the end of the decade, I would say. But if you take that viewpoint, then I think it could be a historically good time to enter, just because KNOS has always been an expensive stock because it basically just reeks quality. But again, it's not cheap, especially in a market which does still represent some buying opportunities outside of tech primarily. But again, I would class this as a tech company for sure. So analyst estimates are really broad, and they have been broad ever since I've been in KNOS, which is sort of nearing a couple of years now. When I sort of have a look here in kind of basically do a look at its 5-year average forward PE, and just use that multiple, so a multiple of 35, I get to 1680. And then I'm probably going to add a little bit extra just because they have a bit of cash, not a huge amount, but still like 5% of their market cap. So it's not trivial either. Then you've also got the annual recurring growth and basically like moving to a more of a SaaS model, right? So I think here, like, you could definitely make the argument to put it even into the 1800s wouldn't be a bad, unrealistic thing for me. Like, I think you can get 1680 just by the historic multiples, which I think are totally still justified. And then you've got the cash, and then you've got the SaaS. So when I first got into KNOS, it was something like £15, and I had a 1720 target on it. And I think that was still pretty good at the time, and so I opened a position. Now, though, I think that once you take into account these additional extras, you can very easily add probably £1 onto that and get to something like 1820, 1850. So I put myself in the higher end here of analyst estimates for sure. But not the highest, and I do also expect that some of these analyst estimates will be updated following these results, and also the DVLA announcement as well, which, like I say, that's 15% of revenue for the DS services, as well as sort of about 10% overall for the company in one contract. So really significant win for sure. So yeah, so I just think, like I say, KNOS definitely deserves your attention. It is expensive. It does have some negatives in the fact that it's relatively light on its recurring revenue. It has also seen a profit squeeze this year that I do think will not get worse, but sort of not get any better for the next couple of years as well. And I do think the next couple of years for KNOS can have the potential to be really transformative, as they've basically got the ability now to operate with the big boys and workday in America. So again, I just think that that's only going to provide it more of a catalyst. And although I'm a bit dubious to oversell KNOS's point about the fact that they're seeing lots of opportunities within government for sort of digitization and automation, the fact of this DVLA contract, the fact of they also landed a Canadian healthcare contract as well, it actually is giving credibility to a company and to a management team that, like I say, has always been really strong, but makes me more confident as an investor. So I absolutely really like KNOS. I think it's one of the best sort of small to medium companies you can find in the UK market at the moment, and I definitely think it deserves at least a review, and then obviously do your own diligence and everything else. But I think it's awesome as a company, and will give you that workday experience without having to buy workday, which is an inferior company to KNOS. Anyway, let me know what you think. That's everything I have for this week. Hopefully it's been useful. It's good to be back. And I guess until next week, good luck with your investing, everyone. Bye for now.